Hi, everyone, this is the Encyclopedia Channel. In the financial field, interest rate is a very important concept. It involves people's borrowing, investment, savings, etc., and has a profound impact on the entire economic system. So, what is an interest rate? What factors affect interest rates? Where are interest rates typically applied? How do interest rates affect us personally? Interest rate refers to the interest that needs to be paid when borrowing funds. It is an important indicator for expressing the cost and benefit of capital. It is usually expressed in the form of a percentage, indicating the proportion of the interest paid each year to the loan amount. For example, if the loan interest rate is 5%, then the borrower needs to pay 5% of the loan amount as interest every year. The determination of interest rates is usually determined by factors such as market forces and central bank policies. Market power refers to the relationship between supply and demand in the market. The higher the interest that the demand side is willing to pay, the higher the interest rate in the market. The impact of central bank policy on interest rates is realized by adjusting monetary policy, such as adjusting benchmark interest rates or affecting market liquidity through open market operations. Changes in interest rates are influenced by a variety of factors. Some of the main ones are described below. 1. Currency supply and demand. Money supply and demand is one of the main determinants of interest rates. When there is too much money supply and too little demand, interest rates fall, otherwise, they rise. For example, in an economy where the central bank prints a lot of money to expand the money supply, the value of the money will fall, and interest rates will fall with it. Because a large amount of money means that more money is put into the market, and the purchasing power of this money in the market becomes weaker, so the interest that borrowers need to pay will also be reduced accordingly. 2. Expected economic growth. Economic growth expectations are also one of the factors affecting interest rates. When people are optimistic about the growth prospects of the economy, they are generally willing to take higher risks, which increases the demand for borrowing, and interest rates rise accordingly. Conversely, if people are pessimistic about the economic outlook, they generally reduce their need to borrow, and interest rates fall accordingly. 3. Inflation expectations. Inflation expectations are also one of the factors that affect interest rates. Inflation expectations refer to people's expectations of future price increases. When inflation expectations are high, borrowers expect interest rates to rise in the future, so they are willing to borrow at higher rates. This is because the borrower will take into account the impact of inflation on the loan amount. If prices rise in the future, the ratio of the interest that the borrower needs to pay relative to the loan amount will also decrease, thus affecting the borrower's rate of return. 4. Bond market. The bond market is also one of the factors that affect interest rates. Changes in interest rates in the bond market can reflect borrowing risks and market expectations of future economic trends. When interest rates rise in the bond market, it means the market is pessimistic about the future direction of the economy, so borrowers need to pay higher rates to attract investors. On the other hand, when interest rates in the bond market fall, it means that market expectations about future economic trends tend to be optimistic, so borrowers need to pay lower rates to attract investors. At the same time, interest rates have a wide range of applications in the financial field, such as some common application scenarios explained below. 1. Lending market. Interest rates play a vital role in the lending market. In the lending market, the interest rate determines the cost that the borrower needs to pay and the benefit that the borrower can obtain. Therefore, both the borrower and the lender will pay attention to and calculate the interest rate. For borrowers, choosing the right interest rate can reduce borrowing costs and increase their own rate of return. For lenders, choosing an appropriate interest rate can reduce risks and ensure their own returns. 2. Stock market. Interest rates also play an important role in the stock market. When interest rates rise, company stock prices on the stock market typically fall. This is because rising interest rates will lead to higher borrowing costs for companies, which in turn will lead to lower profits for companies, which will affect the company's stock price. Conversely, when interest rates fall, the stock prices of companies in the stock market usually rise. 3. Foreign exchange market. Interest rates also play an important role in the foreign exchange market. The difference between the interest rates of currencies in different countries is one of the important factors that attract foreign exchange traders. When a country's interest rates rise, that country's currency becomes more attractive because investors can buy that country's currency at a higher rate. Conversely, when a country's interest rates fall, that country's currency becomes less attractive. 4. Government bond market. Changes in interest rates in the government bond market can also affect other financial markets. Changes in interest rates on government bonds can affect interest rates on other types of bonds in the bond market. For example, when interest rates on government bonds rise, interest rates on other types of bonds typically rise as well, as investors become more willing to buy government bonds. Conversely, when interest rates on government bonds fall, rates on other types of bonds typically fall as well. In addition, changes in interest rates will bring great risks and challenges to the financial market. For example, the following major risks and challenges. 1. Market risk. Changes in interest rates may cause price fluctuations in financial markets. When interest rates rise, bond market prices typically fall and stock markets can fall as well. These changes may cause losses to the investment portfolio, thereby increasing the risk for investors. 2. Liquidity risk. When interest rates rise, so does the cost of borrowing, so borrowers may borrow less, reducing liquidity in the market. This could have a negative impact on the stability of financial markets. 3. Credit risk. When interest rates rise, so does the cost of borrowing for companies, increasing their debt loads. Failure by the company to cover these additional costs could lead to its default, creating credit risk for investors. 4. Regulatory risk. When the government and financial regulators intervene in the interest rate of the financial market, it may also bring risks and challenges to the market. Governments and regulators may take steps to influence interest rates, such as lowering the benchmark rate or implementing quantitative easing. These measures may trigger market volatility and increase market risk. In general, interest rate is a very important concept in financial markets, which can affect various types of investment, borrowing, and trading. By understanding the changes and impact of interest rates, investors and borrowers can better manage their risk and make more informed decisions. So, how do interest rates affect individuals? Some specific cases will be used to illustrate. First, loan interest rates have a very significant impact on individuals. Taking buying a house as an example, if you need a bank loan to buy a house, then you need to consider the impact of the loan interest rate on your monthly repayment amount. For example, if you need to borrow $1 million from the bank, the loan period is 20 years, and the loan interest rate is 5%. Then, you need to pay nearly 6,000 yuan in mortgage interest every month. If the interest rate is reduced to 4%, then the monthly interest payment you need to pay will be reduced to nearly 5,000 yuan, and you can save nearly 10,000 yuan a year. Therefore, low interest rates can reduce your repayment pressure, reduce your financial stress, and help you better manage your personal finances. Second, savings interest rates also have a significant impact on individuals. If you have some money to spare, you can choose to deposit it in the bank and earn a certain interest rate on savings. For example, suppose you have a deposit of 100,000 US dollars and the savings interest rate is 2%, then you can get an interest return of 2,000 yuan per year. If you choose to keep this money at home and not deposit it in the bank, then you will not get anything in return. Therefore, interest rates on savings can help you earn extra returns on your funds, thereby increasing your income. In addition to the above two aspects, investment interest rates, credit card interest rates, and other aspects also have an important impact on individuals. Taking the investment rate as an example, if you want to invest in stocks, funds, etc., then you need to pay attention to the return on investment and risks. Higher investment interest rates can help you get higher returns on your investments, but they also come with higher risks. Therefore, you need to choose an appropriate investment method and interest rate according to your risk tolerance and investment goals. In terms of credit card interest rates, if you often use credit cards for consumption, then you need to pay attention to credit card interest rates. A high interest rate means you pay more interest and fees, adding to your credit card bill. Therefore, you need to use credit cards carefully and pay off your credit card bills as much as possible to avoid financial stress caused by high interest rates. Therefore, interest rates have a very important impact on us personally. We need to carefully consider the impact of interest rates when choosing loans, savings, investments, credit cards, etc., and make reasonable choices based on our financial situation and goals. To sum up, the interest rate is a very important factor in the economy, which not only affects all aspects of our individuals, but also has a wide-ranging impact on the entire economic system. Understanding the meaning and role of interest rates can help us better understand and respond to changes in the financial market. There are many concepts in this program. You can watch it several times to deepen your understanding. Do you have any different views on this? Welcome to leave a message in the comment area to discuss with everyone.